What is up, everybody? Logan here with another video coming right at you. And the Discord and I have had a really good win rate on zero DTE. So I want to make the ultimate zero DTE guide. What I look for, there's 10 things that go through my mind every day when I'm trading the stock market. And these are basically the 10 things. Right now, it's hitting for a 96.5% win rate. We've been 56 for 58. You guys can see I do post my account statements and many of the videos I make for these. And then I call these out in the Discord, which we can pull up right here. So as you guys can see down here, I have all the call outs that I make, and I shoot for at least 6% if I'm going to trade that day to justify my risk. I just don't think it's ever worth picking up 10 cents. Even like 20 credit is pretty low, but sometimes we do open something for 30 credit, have to close it for 15. But I make all the call outs here, and then any management I do, I call in the main options chat because that's where everybody else would be chatting. But this goes all the way back to May when I started using the expected move math. Sometimes I do limit my sizing down based on the day. Maybe there's an event coming out the next day, like CPI data. And sometimes I'll go 10 wide and pick up, this is still a pretty solid 9% per contract. You know, up here, opened this one for 9%, but did close it at 10 that day. So this dates back to, I trade these two because you can trade zero DTE 5 days a week. But I focus on about 3 days a week of hitting it really hard. And if we're really lucky, we get 4. I just don't think I've traded 5 days a week in a long time because we've had Powell, CPI, the bear market's been absolutely brutal. But if you guys would like to come trade with me and us in the Discord, all the other traders, the link is below in the description. Also, please leave a like on this video right now if you could for the YouTube algorithm, and then I'll ask you guys to do so at the end as well. But let's get right into this one. So I'm going to click out of this guy. So the first thing's the expected move math. Now, granted, you might be like, okay, Logan, what's the expected move math out of the gate? Thanks for showing us, you know, your performance, some of the strikes. And like I said, there's other videos I have on my channel if you haven't seen them, where I go over the majority of these trades too. So the expected move math that I do is something Halcyon showed me back in May. And he said, hey, even though we've been super volatile, whatever the expected move is barely gets exceeded. And at that time, it had only been exceeded about 6 times this whole year. And then since then, I think we've exceeded it 10 times, including today. Today, we did exceed it. Today was a huge, almost 3% day in the markets if I pull up SPX stock real quick. So yeah, we had this huge 2.6% day today, and we got up over 3% around 3, closed at 36.78. So going back to the expected move math, so what I do is I go to the Thinkorswim options chain, and I'll show you guys exactly where that is when we switch over to Thinkorswim around number 3. But I will pull up the whiteboard. But for example, today SPX closed at 36.78, right? So we have 36.78. And I want to say that the expected move around close was 47, right? So you do plus or minus 47 for the next trading day, right? So this is what is expected. So granted, now we have this 36.78, and I don't even include the decimal. You might have a question, do you include that 43 cents? I don't. I never have. It hasn't seemed to hinder their performance at all. But this 36.78, so first we're going to subtract 47 from this. So 36.78 minus 47 would come out to 36.31, right? So this would be if the market went down, and I'll draw a little red arrow. There we go. That looks like 36.71. So that's if the market went down, right? So red, bad. You would not expect this to get exceeded. And I'll also pull up a chart in a little bit too to show you guys kind of the last 2 years of trading up until the end of July, where it shows what the expected move was and then how the trading days performed. So this is the first start. And then if we add 47 right here, that would come out to, let's see, 22 and 25. So 37.25 would be the top end of this. So you can expect the market, well, I wouldn't even say that now because I have to go over something as well. Here's the green. If the market goes up, you wouldn't want to expect it to exceed this. Now, what's really fun about making the video today is we actually exceeded yesterday's expected move. It was not 92 points. It was a good probably 45, 44. and we almost doubled that. And a fun fact is when you exceed the expected move, generally you do it again the next day. Not all the time. I don't know the exact statistic behind it. It might be a 50-50 thing, but it's still good enough to know, right? I don't have the exact statistic yet because Vance and I are still pulling all this data together since 2000 so that we can see that data. Because that's one of the last things for us to check is like, how often does that do that again, right? So back to the whiteboard, this is that expected move mass. So that means if I'm going to put a trade on, I'm going to look to do it under 36.31 or above 37.25 just by tracking the previous day's close and the previous day's, or what would be the current day for the one DTE you're going into movement, right? So let's say this then, if you're like, okay, well, how does this help you? Well, if I know that it's 36.78, let's say tomorrow we opened up at, let's say it was down 36.20. Oh, I'd want to make that red. We wouldn't want to make it, we'll erase that real quick. We wouldn't, oh, that's tiny. We wouldn't want to make it green, but let me make that red real quick for you guys. So let's say the market did gap down and we gapped down a good 50 points. So we're now at 36.28, right? So we're actually below the expected move. So this is a really good position to then take a put credit spread. Now, maybe at this moment, the next day's expected move, because the VIX went up overnight, but theta did decay a lot of these contracts. So you might be getting really good premium at like 35.70, right? Which at that point, to get to 35.70 would be almost, or no, it would be over a 2 times move outside of the expected move, which rarely do we ever even go 2 times outside of it. Rarely do we even go 1 times outside the expected move from what the previous day's close was on the Thinkorswim options chain. I'll pull up a chart in a little bit as well that Vance and I were going back and forth on. Then I can show you guys, hey, this is what this looks like. Let me actually do that right now. Here is the trading day expected move. And you guys can see over here the actual movement. And this is dating back to April 30th, 2001. So this is the current data that we have on it. And you guys can see a lot of the really crazy big red days we've had earlier this year, just blowing out the expected move. But other days in here, you can see they were tucked right in them, right? Right in underneath what was expected. So rarely do we exceed this orange line, which is the expected move. And this is the actual move, right? And that's April 30th to July 29th. And then we can click it here and see the calendar days and how often it exceeds it. And you can see how the movement's a little different too. So we have a lot bigger days where you're seeing like a 3.5% to 4% day back in May and April. And then we had a couple days in July where it got super hectic. But this was basically what Halcyon brought to me and said, hey, back, I think it was on this one. Yeah, here we go. Back when it was like early May, it's like, hey, we only exceeded it like 6, 7, 8 times. I think, yeah, and at that point, maybe it was like closer to 12 or 13. But this is basically what we've been using to kind of see, okay, how often does this happen? So I've spent a lot of time on the expected move math part, but that is basically step by step how I use that, which is say, okay, let's say we drop 50 points. We knew this was what was expected. We rarely exceed that. Now let's go all the way down and start our position, maybe 37.50, 35.70, 35.60. Maybe we get closer to the money depending on your support and resistance. So that is the expected move math as if you're in like 3rd grade. If you have any questions about that, please comment below and I can go more in depth about that as well. Second part of the checklist, did we have a gap up or a gap down? So what a gap up or gap down helps me do is we had a gap up today. So the previous close was 35.85 and SPX at open was 36.0978. That is what is called a gap up. We gapped up right there 25 points roughly. And what that does is that allows me to see, okay, now there's a new open gap to the upside. Now, when I go check all my internal indicators, which we're going to get into, do they reflect the gap up or are they kind of contrarian to the gap up that we're seeing? And if you do see that, right, that means generally we go down and fill that gap in the same trading day. Today was an exception. We did not do that. We got big moves up all day, right? Stayed pretty choppy, but kept drifting up as the short slowly got stopped out. So that's the other thing, is like this could open at 36.09, but the indicators not show us that we're supposed to go up. Maybe we're right at resistance. And then you could put a call credit spread on. And then when it goes and fills the gap, you take your position off completely. So that's another way. If you guys are ever familiar with gap fill trading, it's super popular. It's just taking an irrational movement. I think the statistic is 98% of gaps get filled. So anytime you get an overnight gap or a gap off earnings or whatever, expect that gap to get filled, especially in the S&P 500. I think there's only been 3 gaps in the last 20 years that never ever filled. And that's pretty crazy in my opinion, because there's so many gap up and gaps down every day. Maybe it's the last 10 years. I'm trying to remember the exact data for that, but it's a good ballpark. And it's the first thing I say, because if we're gapped up into resistance, I'm going to put a call credit spread on, because we're most likely going to go fill that gap to the downside, right? And if you put even a 37, well, I wouldn't have had any premium there this morning, but let's say at open 36.10, you put on a 36.50, right? Because we opened up into resistance, which not here, we didn't. But let's say it was resistance and this thing sold back to the previous close right here, you'd be able to take that off for almost maximum profit. So that is one very interesting part about this strategy, is just knowing what to look for with gaps, and just don't get caught, right? Like you see the market gapped up 1%, and you put a put credit spread on, that thing could go down, fill that gap, and then keep going. Or, you should have just waited the whole time for that gap to fill. A lot of gaps do fill in the same day, but not all the time, just like today. Okay, so there's the math. Where is the VIX? Okay, so this is where we're going to switch over to the Thinkorswim part of the video. There we go. It's pretty spot on. Tomorrow's expected move's 46.878. So this is back to the expected move math. Briefly, this is where you find that. It's on the right side of the options chain at the top, and it's calculated for you. Thinkorswim shows you that out of the gate. So that's one really interesting thing, right? And then you could take a look at what the premium looks like today. Maybe you said, okay, I'm going to take this 35.90, 35.85 for tomorrow already. You're playing two times outside the expected move, got your 30 credit, on to the next one. So let us go to my charts, show you guys some of the internals here. So as you guys know, I'm a big fan of my 10-day, 30-minute chart. This tells me basically everything I need to know for my 0 DTEs. We'll zoom out a little bit so you guys can get a better look. But it just has my moving averages here, which I go over in every single video that I have. So let me zoom in real quick, show you guys the whole sell real quick. I do have the TTM squeeze on this time frame and the RSI, which I really don't use too often, but it is nice kind of as like a confirmation to your trade, because I'm mainly trading off the expected move and the moving averages, which are the 10, the 21 day. Here we have the 34 day, we have the 195 and the 390. And generally when you get too far from the 195 or the 390, we start to push towards it, right? We were down at 35.84. Now we're up 92 points since then. So it's been a really crazy market out there lately, and this is a great chart to use to kind of see where we are on the playing field, right? And anytime we get too far away, we just always stick somewhat close to these moving averages, and then especially the long-term ones, we try to come and retest them. And even on that last big bull run we had, we were on top of these the whole time. And then one day we sliced right through everything, and I've just been right below them since overall in like the grand trend. So let's first start with the VIX, right? Now that I showed you guys the SPX, the first thing I do is say, where is the VIX? And this is more of like a psychological thing for me, because the VIX is going to basically tell you how much premium you're going to get per position, right? Because this is going to reflect the volatility, because it's the volatility market, or the market volatility index, right? So When it comes to this, I use this same 10-day, 30-minute chart to see if we're going to get any breaks, if we're going to go test a level, right? Like we got really close here. 30 is lining up really well with this moving average. Before then, we had been popping off. The VIX even got up to 35, which has also been another psychological number that the market has liked to sell off. If you guys have noticed that, if you haven't, definitely check that out. The big psychological VIX numbers are 20, 25, 30, 35, and 40 through this whole bear market of 2022. You know, I don't want to generalize it and make that assumption for everything, but I know that at least for this year, that's what's been going on. You guys can see the squeeze was setting up here, fired, and just the market's gone nuts to the downside since then, even further. But we are starting to come back. And maybe if we do get this break of 30, right, that psychological level, you know, then break this moving average down at 29.50, we can really see the market get, you know, a little bull run going. But for now, we have come back to 30. We bounced off of it twice, and it may shoot back up, and the market may continue to leg lower. But that is what I use the VIX for. It is just to see where are we on the playing field. Are there any big psychological numbers that day to, you know, worry about? That can also help you set up if you're going to be bullish or bearish that day. And that just really comes down to how you read the VIX, how you trade it, and how you trade zero DTE. Because I trade zero DTE in credit spreads on the options chain is how I trade it. So let's hop back. All right, did we exceed the expected move yesterday? Now, I did already mention that earlier. Today we did, right? And that's just something to be wary of because most, like, there's a good shot. I mean, it's a 50-50 shot, but it's better than knowing, you know, okay, if we exceeded it today, then only 10% of the time it exceeds it the next day. And then you're like, okay, well, we shouldn't expect it to exceed it the next day. So that's just something to keep in mind right there as well. TOS chart, and that's what I just showed you guys. This is the 10-day, 30-minute chart that I like to use. How to use it, the moving averages. Hopefully that was a good enough explanation for you guys in general. Then we have position sizing. So sizing is a question I get asked a lot, which is like, how much of my account should I go into with these? And then based on my sizing, how should I manage it? And I'm the type of guy, personally, I never have in my life gone over than 10% of my account in a single zero DTE. And if I do that, I have very strict stop losses. I have a very strict criteria. Personally, most of the time that I trade, I do 5% of my account, which allows me to roll, right? Rolling is a super helpful tool when it comes to trading the stock market, especially when it's volatile. And it's the nice thing because many people seem to see like Wall Street bets, right? They seem to see all the big money makers in the options trading space, where I've always seen it as more like consistent income, right? Find something that works, do it consistently for a few years, you know, 8 to 10, 20, 40 years or whatever, even 2 years, whatever your plan is with your money. But sizing, I would just say, honestly, it really comes down to what makes you the most comfortable. You could have $100,000 account, but I know guys with 100 grand that still don't want to put more than $1,000 into a single trade because they know their risk. They understand how the market works. But I also know other people who have a $100,000 account and they're cool with running 10 grand in the zero DTE, and they just have stricter criteria because there's a lot of management ways. So in my opinion, it's just don't use too much of your account, because if you're somebody who uses like 20 to 30% of your account every trade you do, I don't know, maybe you have a 100 grand account and you're doing like 30 grand in QQQ spreads or, you know, Tesla spreads or whatever, there's a pretty good shot that you could blow the majority of your account up. And I say that where it's like, yeah, even though you're only risking 30%, there's certain margin requirements you need for your account, right? If you're trading credit spreads or trading zero DTE or however you want to trade it. And then it comes down to like, you're going to get emotional. You're going to try to revenge trade, which is going to risk more of your account. So I would just say whatever keeps you the most comfortable, because greed is one of the most brutal things to deal with in our day-to-day life, right? It's like you could win 2 grand in a day, and some people stop and say that was incredible, and other people keep going. Maybe they make another 2 grand, or they lose it all and they're back to zero for the day. So that is my opinion on position sizing. Then we have trade timing, which is a very, very common question I get asked. And it's like, how do you know when to take your trades? Well, I use a couple things, but we'll zoom out a little bit. But like, for example, I didn't trade today at all. I'm glad I didn't. There was a gap up and we went immediately above the moving averages. There's really rarely ever a time you come back down after doing that in the same day. But what I do is I usually give the first at least 15 minutes to 30 minutes to let the market shake out. And then I simply look at where I am on these moving averages. I look at, did we have a gap down, a gap up? And then I also look at the market internals, which right here, you guys can see I have the advanced decline, which shows you the amount of shares advancing versus declining over the whole New York Stock Exchange. We have the tick charts and we have volume distribution. So you can see that we were green all day and the market just kept running. And then the ticks will show you like when you have really large institutional buying or selling. And I have those levels where you get heavy selling at over 7,000. But if you're ever over 1,300, or sorry, 1,100, you're seeing, and you can, 1,300 sometimes too. You're seeing institutional buying and huge levels of purchasing just come in on the market or selling. So this helps me determine like, okay, if you see the ticks at over 1,000, the market's probably going to continue to head up. And same with the ADD, right? This will help you determine, okay, where is the volume going? Because you can hide a lot of things in the market, but they can't hide where the price is going, because to make the market move up or down, you have to make a decision whether you're going to buy or sell, and if we're going to all do it as a group, right? That's the whole funny thing about the Wolf of Wall Street, right? It's all fugazi. It all depends on how the whole crowd moves it today. So whatever that reason is for you guys, for your entry criteria, this is mine because, over 2,000 on the ADD generally means we're going to see a really big buying day. A lot of the move happened overnight, but not all of it, right? Sold off in the morning, then immediately started buying back up. So that's how I make my decision. And I usually sit out the first 15 minutes because, look, the market sold all morning, 10 straight minutes of selling. And that's literally just for Mark to screw you. Like he does that on purpose, and that's the market makers to take your money, right? So that's everything for that one. Let's go to choosing strikes and how I choose my strike. And that is a combination of basically everything I just went over. And that's why choosing strikes is number 8. Because if I'm in a 0 DTE, and we'll act like this is a 0 DTE here, and I'm like, okay, well, let's just treat it like as if it was a 0 DTE, but it's very similar criteria as if I was going to swing it. But let's just say you're looking down here and you're like, okay, I know the expected move shouldn't exceed 36.31. We closed at 36.78. Let me go look at 3,600. That's a big psychological number. Maybe if I sold this and bought this one, right? Sell 3,600 put, buy the 35.95. You're going to collect 40 cents or $40 on your $500 at risk. So right there, you're looking at an 8% return, and you have a 90% chance that trade makes profit at some point in the trade. So that is one interesting thing right there. You could slap that on and boom, you get your 40 cents. You're on to the next trade, maybe 45 on it. You get a nice fill. And then you can close that out at the end of the day or let it ride. So that's how I choose my strikes, is basically by using that expected move math that we talked about earlier that was on this whiteboard. And I see, did the market fall? Did the market rise? Where's the market now? I put myself at the best probability where I have good risk to reward, psychological level, right? And then at the same time that I'm doing that, using the psychological level, finding good risk to reward, I size properly, and then we use the expected move math, and generally at that point, everything's good. Now, you asked, okay, how about your 2 losers then, which takes us right into our risk management part, which is number 9. So with risk management, there's a couple things, but I mainly just roll trades, and I roll them before they get into the money. That is the plan. Now, occasionally, that's something you can't control, which is why you want to keep cash in your account, because that lets you widen it, or you can pay a debit to roll and then condor it and completely finance your trade with the other side of the trade, right? Like if a put spread got breached, you could get a call spread to finance the debit of the roll. So with risk management, both my losses were 3x losses that would have expired worthless. But what happened was it was about 10:30. So let's just use today's trading, for example, which I didn't trade today, but this would have happened to me today. If I did, I would have gotten stopped out because I was looking at the gap up. And that's why I wait this 30-minute candle out. And then once I saw this breakthrough, I messaged the Discord and said, I'm not going to trade today. We're already up. At that point, we were up, 60, almost 60 points, almost 2%. And we're over the averages. So we're most likely going to keep drifting upwards, right? So I told them, I'm not trading today. I don't like our setup. And I'm glad I didn't, because I probably would have got stopped out on this candle because I would have been up at like 3,700. Now, granted, I don't use just the credit to determine if I'm getting in or out of a trade. I look at where our pivot points are, where our resistance is, and then I make the decision with the other traders in the group, like Vance, right? And I say, hey, I'm looking at this level. This is where our support is. If we break this level, should we take this position off? And generally, you want to set yourself up to where that's going to be around that 3% or 3 times the credit. So if you open that trade for 50 cents, you want to be able to close it for $1.50 and just lose $1 debit. So that's what I end up doing with that trade specifically. For both my losers, they did end up expiring worthless, but I did end up stopping out, and that is just part of the game of trading. That is something you're just going to have to deal with and learn, as even the best traders, even the worst traders, whatever it is, everybody's going to get stopped out at some point in your career. And then that thing's going to go to max profit, or it's going to go in the direction you wanted it to go, right? But you are already out of the trade, because that is how trading works, right? That's the psychology behind it. You're going to feel the max pain for a bit, then it's going to push back. So it's a really interesting like ebb and flow with the markets for that mindset. But that is kind of my opinion on risk management, is just make sure you roll before you get in the money. If you're going to roll a trade, just make sure you can match the delta to wherever you're rolling, whether it's into tomorrow. I prefer rolling into tomorrow because that allows me to take my risk off very quickly if I'm right on the first roll, which generally I am, because to get the first trade wrong with all the criteria and then get it wrong again is, I would say, just as difficult to do that as it is to hit 2 like perfect winners, right? It's kind of like if you're a sports bettor, hitting a 2-leg parlay is just as hard as losing both the legs of the parlay. So that's kind of my thought process here. That's everything I go through trading. And then the last thing is expectations, because we all set expectations, right, in our head. We'll go back to the checklist. And the thing is, right, this is a really fantastic win rate where I'm collecting 6%. And I use the same, that's also one thing I want to talk about with expectations was I'm not scaling an account, because you're going to scale your losses when you scale an account up, when it's like you put the full or compound, right? Like, let's say you started with 20 grand and you got it up to 22 grand or 24. So now you're sizing your contracts up. I'm using the same steady contracts unless I say, hey, we're going to size down. Rarely do I ever size past 20. 20 is my absolute, like, most contracts I'll get on something as of lately because of the volatility. But granted, like with this specific 0 DTE strategy that has a 96.5% win rate, both the losses were able to be made back within the next 2 trading days. That's with expectations here is like, if I was to let even a couple of the, probably like 4 of them go for a max loss, it wouldn't be profitable. But the thing is I'm catching it. I'm getting really good at the entries, really good at rolling. I have the money there if it's available, or if needed, when it's available and absolutely needed to roll something, right? Like to roll this contract, and I let it get in the money. So now I got to widen it or pay this debit to do that. And also when you're playing so far out of the money, like I said, if you get a day like today where it's like 92 points up, generally we don't have another day where it's another 92 points up. So if you're able to roll ahead of time, maybe pull yourself 50, 40, 50 points further up because you didn't let it get in the money, or you roll the dice, right? And you can use the expected move for the next day too to set yourself up in your role. But most of the time, I do decide to stop out of a trade if I feel like I'm either too heavily invested in it, getting emotional, the market's being extremely irrational, which happens a lot this year. But also, yeah, like I said, setting your expectations, because you can have like 4 or 5 of these become a max loss, and then you got to sit and rebuild like every 10 trades you put on, right, is equal to one absolute max loss, or, for every 9 trades you do is like one absolute max loss. But that's why I size the same contracts every time, because right now by doing that and getting at least 6, 7, 8, and I'll show you guys the Google sheet too. I just have to get a couple more rows filled out, and I'll bring that to the seminar that Vance and I are going to do, this in-depth 0DT seminar for everybody on that. But I'll bring that, show you guys all the strikes, the trades, all the fees, and that combined with it. So something I'm working on with Vance that we're almost finished on, just so that we can show you guys how important it is to stop out. And it's okay to lose money, because you're not in, when you're in the stock market, people like to say you're in the business of making money all the time, which is not true. I actually think the stock market, and many experienced traders will tell you, it's actually the business of not losing money all the time. It's how do I reduce my risk? How do I preserve my capital? It's not trying to double your $10,000 overnight because you bought naked calls going into, an earnings call, right? That's not how this is. The market is, for how I trade it, is you come to the market with like 25, 30, 50, 100, 200 grand, and you say, how do I set my expectations properly, manage my risk, and maybe I can grow this account 80% over the year, right? Maybe 60% over the year, because that's my expectation, is 80% a year on my accounts, which honestly you can lose a lot and still make 80% just because you're consistent every single day. So that's going to be all the 10 things I go over in this video. I hope this helped you. If you guys have any more questions, like I said, Vance and I are going to be doing a 0DT seminar, which we will talk about in a video. You guys can sign up for that. We'll go over everything there, but this is basically the main 10 things that go through my head every single day when I am trading the S&P 500. I just trade SPX with 0 DTE because it's cash settled, right? There's a lot of good benefits to it. There's also, it's good for taxes because you don't pay all the short-term capital gains. You pay some short-term and some long-term on the income. So that helps big time. And there's a lot of cool ways to trade this market, but I have been loving this lately because even when there's this crazy volatility and swing trading is not working, you can hit some pretty good day trades. And if you just do that consistently for like 8 to 10 years, you could have $2, $3, $5 million, $250,000, like whatever your goal is, you can do. You just have to keep your money safe, right? Don't risk all of your money. And then also be patient, right? All long-term success. And most people that make a lot of money did it over the long term, and they had to do that to maintain that. You have to do it consistently. So that's why it's important to set your expectations so that you know what you have to do to get to your goal. And, we're dealing with the market, so most likely it's a financial goal or a professional goal or a career goal, or you're like, Logan, I just want to buy 1,000 rubber ducks. So I need to make $1,000 because I want 1,000 rubber ducks in my house. And I'd be like, all right, well, here's how you do it. And then we set your expectations, and then boom, you have 1,000 rubber ducks off Amazon. Call it Mr. Bezos. Yo, thanks for the rubber ducks. I appreciate it. So that's going to be everything for me. Leave a rubber duck comment below. Can you get that emoji? Is that an emoji? Let me look it up real quick for you guys. I want a rubber duck emoji if that's not a, oh my gosh, please. Is this real? Oh my gosh. Look at that. If you guys could leave a rubber duck emoji, or just a duck. Maybe there's not a rubber duck one. All right. Well, if you guys could leave a duck emoji down below, if you made it this far, I appreciate it. Make sure you guys leave a like. I want to see you guys get better at trading. This market is hard as it gets. It is not easy. I promise you it's not easy. There's so much that goes into this. We'll get off the rubber ducks for now, but I appreciate all the support as always. You guys are the best. I couldn't do this without you guys. You're the fans that watch every day, so I get motivated every day to be a better trader. Show you guys how I do it, strategies I'm running in the certain market conditions. So that's going to be everything for me. I'm going to go get some food. Me and Jabba are getting a little hungry. So, and this little thing, what is this little thing right here? So that's going to be everything for me. I appreciate all the support. Make sure you guys check out the Discord link down below. Leave a like, a subscribe, a comment. Hopefully it's a duck. And I will see you guys in the next video.